If you give a gift, a financial gift to a family member, some cash, maybe some investments, maybe real estate as you're aging, as you're getting older, if you give a gift to a family member, a friend, someone else, is it taxable to them? Is it taxable to you? I've got those answers coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Corehorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Get this question all the time. One of the most common questions is, hey, I want to give a gift to my child. I want to give a gift to my grandchild, or my parents, my mom is a widow and she's aging and she wants to start giving some of the money away so that the state or the nursing home doesn't take it. How much can I give before it's taxable? And really embedded in that is, if I give a gift, is it taxable? How does that work? And we get this question multiple times a year, and we've talked about it before on the show, but I want to break it down because there's really three types of common gifts that people give. They either give cash, which they just write a check or something like that. So you give cash. You give investments, you give stocks, okay? That's different. And then you give real estate. So I want to break down each of those. Let's get into it. So if I give cash to someone else, is it taxable to them? Is it taxable to you? No, it's not. And there's a couple ways I want to break this down, because in a way it depends, but no, it's not for like 99.99999% of you, okay? You can give anyone up to $15,000 a year and not even have to tell anyone about it. You can. Doesn't matter. It can be $15,000 to a child, to a grandchild, to a friend, to a neighbor, to someone that goes to your church, to an absolute stranger, and you don't need to tell anyone. They don't need to tell anyone. There's no taxability to it, okay? That's the annual gift exclusion. And we're not going to get into it today, but there's gift splitting, which means you can give a married couple $15,000 each, so 30 grand. And if you're married, giving money to a married couple, you can each give 15 to each of them. So 15 and 15 and 15 and 15. So $60,000 without reporting it, without telling anyone. So no, that's not taxable, and you don't even need to worry about it. You can give it to whomever, whenever, at any time, okay? That's if you're giving cash. Well, Mike, what if I want to give more than 15 grand? When I'll give you my address. I'm just kidding. No, I mean, this happens. This happens occasionally. If you've received an inheritance, want to bless someone else, a big bonus, want to bless someone else, or you're doing some gift and tax planning. Well, if you give over that $15,000 or even over that gift splitting annual amount, then you will have to report the gift. But there still is a great likelihood it's not taxable. Why? Because anyone can give anyone else up to $11 million in change during their lifetime. Once you give over that $15,000 annual limit, you then just have to report it. The IRS needs to start that tally of, okay, yep, I've given $100,000 to this person, so put that on my permanent record, and if I give them almost $11 million more dollars, then okay, fine, I'll start paying a little bit of gift tax on it. So I'm not going to give you the exact number. You can look it up. It's 11.5 million, something like that, right around there. There's a lot of talk of them bringing that down to 5 million. Lots of talk about that changing. It very well could change by the time you're watching this, but in essence, annual gifts of cash of a reasonable amount, $15,000 or less, or gift splitting $30,000 or up to $60,000 per year, not taxable. You don't even need to worry about it. Nothing needs to be done. If you're gifting more than that, you'd need to do a gift tax return, but likely, I think 709 tax return, so tell your CPA about that, but likely no tax due, okay? You'll have to pay your preparer a little bit for them to make sure you're in compliance with the IRS so that the IRS knows, okay, thanks for reporting that gift, I got you. I'll keep track of that now. But no tax due, okay? So that's giving gifts of cash. What about giving gifts of an investment, gift of stock? We do this all the time. Help people with this all the time. Another video that we'll do is talking about when you're donating to charity and you've got some cash, but you've also got some non-IRA stock. Which one should you give? Ooh, we'll come to that. But we've already talked about cash. So let's assume you've got some stocks that you want, some investments you want to give to, let's say, a family member. Can you do that? Well, yeah, here's how that works. If it's an IRA or a Roth IRA or a 401k, you have to withdraw the money, and then you're going to have to pay tax on it. That'll be income tax, okay? Unless it's a Roth. And then you'll give them the cash. So it will work like an IRA or retirement account withdrawal and then a gift of cash. So that's unique. If you have a non-IRA, just a normal investment account, an individual account or a joint account, and you want to give some of the investments, not sell the investments yourself, but give the investments, give the stock to a child, family member, someone like that. Well, there's once again that $15,000 annual limit. Okay, if it's below that, you don't need to report it. If it's above that, gift splitting still occurs. If it's above that, though, you might need to report it, and it would go towards that 11.5 million or whatever the exclusion amount is. Okay, but then here's the key point: if you're gifting an investment, you gift them your cost basis, which means you gift them that unrealized capital gain. Let's say you bought a mutual fund for $3,000 and it's grown to $10,000. Well, you give that mutual fund to your family member. It's worth $10,000. That's below the $15,000 annual exclusion. So no problem. No tax to you, no tax to the person that received it. You don't even need to tell the IRS. But then let's say your son or daughter, whomever you gifted the money to, says, "Oh, thanks for that stock, Mom and Dad. I don't want this stock. I want a different stock." Or, you know what, I'd rather have a truck, so I'm going to sell this. So they then sell the $10,000. They have to pay capital gains tax on the difference between the $3,000 that you originally bought it for and the $10,000 that it's worth today. So they've got to report that $7,000 as capital gain when they sell the investment. You can't get around the capital gain rules by taking your stock and giving it to someone else, because you gift not only the stock, but you gift your cost basis. Does that mean you shouldn't do it? No. That means you need financial planning. It very well might be that, hey, if I sell this, my capital gain is going to be at 15%. In fact, it might be up to 25%, and I've got these other taxes. I'm going to gift it to Johnny. Johnny will be at the 15% tax, or some of it might be capital gain taxed at 0. Therefore, we should gift the stock to him instead of, right? So you got to do financial planning on that. But just know the key point here is if you're gifting an investment, you also gift your cost basis, meaning when they sell it, they will have some capital gain or possibly some capital loss that they will realize. All right, now what about gifting real estate? That's the last common question that we get. And this one's common not because, oh, you know what, I've got this house and I sort of want to give it to my kids. I mean, that happens. Pretty rarely, though. More likely when it happens is a grandparent or a parent or someone just became a widow or widower. And maybe they've gone through it, or maybe they've seen someone else go through Medicaid or go through the expensive process of needing care and needing assistance at that age and stage of life. And so they've said, I don't want my house to go to the nursing home or to go to the state, or I don't want the state to take my house, therefore I'm going to give it to you. And sometimes people not only fear that they're going to take my house if I need care, but they also feel at this point that they don't have as much control and freedom. They don't have as much choice in their life. Well, then I can choose to give my house, and I'm going to take control and give my house away. So that's where that comes up. And a couple of things I'd point out. And work with your certified financial planner. If you're thinking about doing that, your grandparents are thinking about doing that, your parents are thinking about doing that, talk to your certified financial planner, because there's lots of factors to consider. But the first one is, just like with gifting an investment, when you gift real estate, when you gift a house, you're gifting your cost basis as well. Typically for our primary residence, we don't think about cost basis. I paid this, it might be worth this. I've put a lot of money into the house along the way. And so, yeah, there might be a little bit of gain there, but it's no big deal. Well, it's no big deal because as long as you've lived in that house as your primary residence for 2 out of the last 5 years before you sell it, then $250,000 of that gain is not taxable. It's not reported. It doesn't matter. And if you're married filing jointly, then it's not $250,000, it's $500,000 of gain Doesn't even matter for taxes. But if you gift that house to someone else, you're gifting your cost basis as well. And if when they sell it, they haven't lived there for 2 out of the last 5 years before they sell it, then they've got to report that as capital gain. And so we see this a lot where let me go back to that scenario. I'm gonna, I just became a widower, or I am a widower. I might need care in my lifetime. I don't want someone to take the house, and so therefore I'm gonna give it, okay? Well, when they give it, they're then exposing themselves, their family, to capital gains that they otherwise wouldn't have. And then also, that gift still counts against them for Medicaid for up to 5 years if they're not doing careful planning. Additionally, they've gifted that house, and now it's that son or daughter's asset. So if son or daughter are in a car accident or sued or get a divorce or something like that, that asset's now exposed, even though it's technically mom or dad's or whatever. So there are certainly times when you'd want to gift a house, but that's how it works from a tax standpoint. And those are some of the considerations why you're going to want to talk to your certified financial planner. Obviously, and I would assume that most houses are going to be above that annual gift exclusion amount. So if it's above that $15,000 limit, then you're going to report that. Okay, you're going to report it on that 709 tax form. But again, as long as that house's value is less than 11.5 million, or you haven't reached that lifetime exclusion amount by giving other gifts, then it's just going to be reported to the IRS on that 709, but not taxable. So that's how it works. That's how giving and taxes work. If you're giving cash, if you're giving an investment or stock, and if you're giving real estate. The big point is, no, for the most part, it's not taxable. You might be giving your cost basis. Do tax planning, do financial planning. That's how you know when, how much, and whether you should give cash, give stocks, give a house, or wait and not give any at all. Work with your certified financial planner on that. If you don't have a CFP, you can contact one on my team. Find us online, Korhorn.com, that's Korhorn with a K, or wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.